Kia ora, welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Leighton Roberts and I'm one of the co-founders and co-CEOs at Sharesies. Today on Shared Lunch we're joined by Jeremy Muir, a legal expert on cryptocurrencies. We're talking today because of the recent changes where the US regulators approved 11 Bitcoin ETFs, and we're going to talk about some of the impacts those might have. But before we get started, here's a disclaimer.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Jeremy. Thanks so much for joining us. Let's just get started by you telling us a little bit about what you do.
Sure. Kia ora, Leighton. Good to see you. Good to see all of the Sharesies people out there. I'm a big fan. Been working with you guys for pretty much since the beginning. But one of the other things I do besides sort of fintech and platforms like Sharesies is I do a lot in the blockchain crypto space. So I'm a partner at Minter Ellison Rudd Watts, one of New Zealand's large law firms, and I work a lot on the sort of financial products, financial advice space.
Amazing. Well, thanks so much for giving us your time. Let's just kick straight into it. It's been a big start for cryptocurrencies, or in that world anyway. We're hearing a lot about it, which is the US regulator approving 11 Bitcoin ETFs. So how is this significant and why?
Yeah, it is significant. And it must be said that it's a grudging acceptance by the US regulator, but it has happened. I mean, what this means is that an asset which is kind of outside the traditional financial sphere, Bitcoin, which is for people to invest in or to buy or to hold, they've pretty much had to do it using non-traditional marketplaces and non-traditional ways of buying and ways of holding. And it's been kind of a very DIY market generally, has moved into, or at least for Bitcoin, one of many crypto assets, but by far the biggest, you can now buy and hold by buying a regulated, listed US investment trust, kind of like you would buy exposure to shares or to gold or to silver by buying units in one of these exchange-traded funds or ETFs. So it is a big deal. It's psychologically a big deal for crypto industry and markets because they've been waiting for this as kind of a bit of a validation of some parts of the market. But in practice, what it does is it just provides another option for people if they are interested and want to sort of hold some Bitcoin or exposure to Bitcoin as an asset in a relatively regulated and well understood way, including through someone like Sharesies.
Yeah, nice. Thanks so much. It was interesting. You touched on that comment right at the start, sort of begrudgingly, which was interesting. They took their time, didn't they, as far as getting this approval out? There's been some declines, and I went as far, I think, as putting a statement into the thing, sort of saying, look, we're not endorsing Bitcoin here. What we are doing is approving these ETFs and less taking it. They don't form a view effectively on it as an investment or the legitimization of that, which I thought was an interesting step because they obviously approve a lot of things, and a lot of what is regulated doesn't turn out to be a good investment either. They very much don't take a view on anything. They're not saying when they approve something, hey, this is going to be a good investment over time. So why do you think they took those extra steps this time around?
Yeah, well, it's been a long story. This is the quest to get an exchange-traded fund listed in the US for Bitcoin as an asset has been, nearly 10 years in the making. Goes back to the Winklevoss twins who were, out of the Facebook story, getting involved in the industry and trying to do that. And then many years of toing and froing with the SEC. The SEC, under its current boss, Gary Gensler, has had a bit of a fractious and hostile attitude to crypto assets, digital assets generally. There have been a lot of lawsuits. Having said that, it's not homogenous. There are other important people at the SEC who have been a lot more willing to say, look, this is not our job to decide that something is good or bad specifically for people. We just need to apply tests consistently across the markets. So that's kind of working through those issues has been what's taken time. And it's fair to say that, what changed now, possibly the only thing which has really forced the SEC's hand is that they did receive a court judgment against them saying you guys are not playing fair in terms of why you've allowed some types of ETFs which deal with Bitcoin futures, but not these ones which deal with spot, which is holding rather than trading futures. What's the difference? You can't really do that. You need to be, apply the rules more fairly. So that's what's kind of changed. That's probably what drove them to perhaps come out with this decision now, but no doubt there are other factors as well.
A few latent thoughts on that. Like I always wonder about the term ETFs. For most people, sort of so aligned, aren't they, to passive investing and basically the S&P 500 type thing. And now, more recently, probably very recently actually, in the life scheme of ETFs, we've moved into these single asset classes, and now we've gone one further into single asset classes that are may or may not be regulated as financial assets. So it's finding that journey interesting and wondering sometimes if there's just a name convention type thing to help with the warning labels, but there's other ways that we can achieve that. Anyway, this time round, of course, we've got some pretty big hitters in there, like BlackRock, right? One of the fund providers, one of the largest fund managers in the world. I'm sure they have enough money to get something through the courts. And then there's Cathie Wood's ARK one, who has been involved. So what about Bitcoin and ETFs? Is it, having had all these ones declined previously, meant that we've finally got them over the line, or was it always just a matter of time?
Yeah, well, I mean, it's a matter of time, but to be fair to the SEC, or to take it from another angle, there have been things that have needed to happen as well. So the SEC's apparent issue with having these sort of funds is that they were unhappy with the underlying markets for an asset like Bitcoin, in the sense that it's traded on a lot of exchanges and peer-to-peer in a number of ways which are not regulated. So even though you could have an ETF at the top which has a licensed fund manager like BlackRock, which is heavily regulated, the assets have to be held by licensed custodians and supervisors and things in that jurisdiction, that's all fine. But if the underlying asset is traded in markets where price discovery is a bit difficult, or there's just huge volatility, that there are scams and issues with people front running and all of those things that can happen in unregulated markets, that's what they were concerned about. But the asset class had developed to a point where there was a lot of institutional action, so it was now starting to look like it was becoming something that, all right, larger players can invest in, institutional investors can invest in, but we're not going to let retail investors invest in it, except that they can go out and buy it in a direct way in any number of ways. So it got to a point where I think it had to evolve to allowing sort of retail investment through these regulated retail channels.
Yeah, interesting. We might just take it a step back quickly on what exactly it is that's been offered this time. You touched on it earlier. There have been different types of crypto-based ETFs that have already been launched, and actually with some hype previously. So we have like futures type funds available already. We also have funds that have companies in them that deal in the business of cryptocurrency, Coinbase and the likes. And then we have what we're moving to now, which is the first spot price Bitcoin ETF. So maybe you could just break that down for us. What does that actually mean?
A spot price ETF is basically just a vehicle that buys and sells, or rather just buys and holds Bitcoin, and actually they are buying it, they are holding it through their custodian, in this case Coinbase, for quite a number of them. There are some others. And so therefore the value of your shares in the ETF are pegged to the value of Bitcoin on the open Bitcoin market, because the fund is actually holding actual Bitcoin, if there is such a thing as actual Bitcoin. So that's the spot aspect of it. What had happened before that is that there were some ETFs that basically invested and traded in futures, so derivatives, and SEC's story as to why they'd permitted that was that was another layer of regulation already, because the trading in futures happened on regulated markets in Chicago and other places. So the ETFs that we've seen now in this latest round, it is really a direct exposure to Bitcoin held in a wallet by the custodian. So it is an alternative to going out, downloading a digital wallet on your phone, or using one of the crypto exchanges that exist and just buying and holding those digital assets yourself. Now, though that sort of direct holding is quite, it comes with its own risks in the markets, because a lot of people who have tried in this area have struggled with, you download a wallet, you upgrade your phone, you need to reinstall the wallet, then you need a 12-word seed phrase or something to get back into it. And because one of the whole points of Bitcoin is it's decentralized and not reliant on sort of one owner or issuer of Bitcoin, you can't necessarily get access to it if you've lost your codes and things. So you really, if you're going to do it directly, you have to spend some time, do your own research, and get on top of the rules around how you hold it. Whereas now with the ETFs, you can sort of put all of those issues on the ETF provider and just say, this is just like holding shares in the US top 500 companies ETF run by BlackRock, something like that. I'll hold it in my Sharesies account or however, and I don't have to actually directly understand or get to grips with those sort of technical issues.
Great, and hope and trust, I suppose, that they have those the wallets and stuff stored very securely and very well somewhere, which I'm sure there's been a big process around that. Look, you mentioned a few things there that I'm keen to dig into. The Bitcoin. You mentioned Bitcoin. If you could hold a Bitcoin or whatever that sort of is, and that's one of the interesting questions around crypto and its future and stuff, I suppose, and particularly when you think about an ETF, which is an investment tool. And I'm not sure if you can inform us a little bit about the background, but if whether it was envisaged early that it would be used as a store of value as its sole purpose, because of course, if you hold it in your wallet, you can pay someone with it, you can make a payment, you can do these other things. But if you're holding an ETF, you're really doing it for one purpose, right? Which is ultimately hoping that over time that value grows versus another asset. So anything on the history of Bitcoin and how we sort of got here with regards to that?
Yeah, and look, that's a fascinating topic. If you go back to the creation of Bitcoin 2008, a person or persons calling themselves Satoshi Nakamoto publishes a written white paper saying, here's a new way that we could do an electronic peer-to-peer payment system that wouldn't rely on intermediaries like banks, and it wouldn't rely on government-issued currency like fiat, New Zealand dollar, US dollars, all of which at that time, post the GFC, global financial crisis, was coming under a lot of strain. There were a lot of issues and perceptions that all of that sort of value in the currency was subject to itself fluctuation or manipulation by governments to print more money, all of those sort of issues. So Bitcoin, following that written paper, the code was then anonymously launched. And what it does is it sits out there able to be used by anyone. It's not run by a government or even by a group of people anymore. It's pretty much self-maintaining. And yes, it was originally designed for peer-to-peer payments. Then what has happened over time is that a number of things have spun out of that. So while it can still be used for payments, that hasn't really been the key use case that's evolved. Actually, a lot of people have taken to see it as kind of an inflation-proofed, government interference-proofed form of asset or store of value. So that's one reason that you might hold. There are a number of reasons that you might hold Bitcoin either through an ETF or directly. One, so you can make electronic payments to people or transfer it to peers. In that case, you'd really need to hold it directly, not through an ETF. But if you think of it as a store of value which is independent, won't necessarily go up or down with national currencies, then you could hold it as a store of value, much as you might hold gold. So it's often described as digital gold, gold or silver. And if you're going to do that, rather than having bars of gold in your basement or Bitcoin on a digital wallet that you hold, why not do it through an ETF? The other investment story is that a lot of the technology behind Bitcoin, which we generally refer to as blockchain and digital assets or crypto assets, has really spun out into a lot of other quite interesting use cases, particularly around what we call Web3, the metaverse. So the fact is, as we grow and live in an increasingly digital environment, we need digital native ways of paying each other, recognizing that we own things and digital things in a digital environment. And all of that sort of, blockchain technology is one of the ways that you can do that. And there are plenty of absolute zealots who say it's the everything, plenty of people who will say it's nothing, it's doesn't solve actual real world problems. But if you believe somewhere in the middle, then holding an asset like Bitcoin, which is kind of the foundation for this technology, is kind of a proxy for, if you believe that blockchain is going to sort of grow and evolve. Because as it grows and evolves, the price of an asset like Bitcoin might grow with it.
Yeah, nice. Good explanation. Thank you. So what do we think this is going to mean for retail investors broadly? We're seeing a bit of volume through the Sharesies platform already, maybe not as much as the hype would have suggested, I think, but one of the big reasons this was such big news is it opens up massive pools of money to fund managers that within their mandate can invest in listed products, particularly on US exchanges. So a bit of a wide topic there, but how do you think it's going to play out day to day with regards to people's KiwiSaver, retail investors broadly?
Yeah, there's a lot to unpack in that. And I mean, the level of interest, Bitcoin is quite sentiment driven. It does tend to, everyone talks about it when it's sort of going up, or if there's a scandal or something which has happened in those unregulated parts of the market where it's absolutely fair to say that, there have been huge problems. And what we've seen also in the Bitcoin price is that it's sort of over the last little while, with the expectation that these ETFs might well be given approval, that's probably been priced in a little to the price. So when they actually launched, it hasn't necessarily soared up further. So if you read around, and I'm not an expert on pricing or financial markets, but if you read around, you'll hear lots of explanations about, buy the rumor, sell the news. So everyone kind of knew that these approvals were coming. So the uplift that was anticipated has kind of happened. So that part of it's played out now. But I think as you say, the next part that will be interesting to watch is the business so far has really been people who are already, interested and associated with, or have some understanding about Bitcoin, have kind of gone in, or maybe have transferred some of their direct holdings into the ETFs. The really interesting part will be what happens next. And do we see financial advisors across the US saying, actually, maybe it's a good idea to have a small part of your portfolio in this volatile but historically outperforming in many years asset. So let's start to move some of those things. So that won't happen immediately, but it's anticipated it could happen over the next few months. And then you get, as you say, institutions, pension funds, all of those things where they may have either both mandate legal restrictions saying we can't hold these unusual assets, which we'd have to, hold outside our usual custodians, or even practical issues like we don't understand how to hold things in digital wallets. What is a cold wallet? What do all those things even mean? We have no idea. As it becomes easier for them to simply get exposure to this asset class by holding shares in an ETF, you might well start to see some of those move. And in New Zealand for KiwiSaver, I mean, that's a really interesting question. There are already a couple of New Zealand fund managers who have dabbled or have invested in and hold crypto assets, and they have performed in a volatile fashion, but often very well and sometimes very unwell, by holding those assets. The really interesting thing will be whether it becomes a more broadly accepted part of a portfolio to hold a small amount. And that's for bigger brains than certainly for me as to whether that's a good asset allocation decision.
What's your view on the sort of the New Zealand psyche around crypto and stuff? Because we spend a bunch of time in Australia. It certainly gets talked about a lot more over there, I think. US even more so, particularly when we see tech entrepreneurs and stuff come to New Zealand. The crypto world is spoken about a lot more, which is interesting. And if you just look at the volumes going through, so the size of the ETFs, my understanding is I've already surpassed the silver ETFs, which is material, and they're sort of hunting down gold next. So it's overseas, there's some big money flowing in here, right? So where do you think New Zealanders are at with regards to this journey?
Yeah, I mean, the psyche point is interesting. I think there's also just an element of distance, and it's not a traditional asset for New Zealanders. So we haven't quite got our heads around it. It's not a house, exactly. And, we like houses.
House ETF. They do exist, sort of residential funds. But
yeah, I think it's something that as we get perhaps some New Zealand companies that become more successful in this space over time, or in the broader sort of digital asset space, maybe we'll catch up. But it's also, it just hasn't been sold in as large a degree here as it has been, say, in Australia, where literally there are a couple of hundred exchanges based in Australia advertising and trying to sell sort of crypto assets to Australians. So in New Zealand, it's been a bit more low key. There've been a couple of high profile companies, a couple that have done well, a couple that haven't done well, and that have no doubt people have lost money on as well. So that sort of thing doesn't help in a small market like us. So, watch the space. I think it'll evolve with interest.
Yeah, it'll be fascinating to see when the next, well, assuming it does happen again, history would say it will, the next sort of bull run for Bitcoin and Ethereum type happens, because twice in Sharesies history, when we first started, and then probably about 2.5 years ago, in both large bull runs of the crypto market, that was the most requested thing coming through our investor care platform. So it'll be just interesting to see how it plays out when that happens again, because it feels like when it's being talked about, it's being talked about a lot, and always interesting to watch that. I'm a small holder of some crypto myself, and I do not profess at all to understand it. I don't, and I've tried quite hard actually on things, but at the end of the day, my view is sort of that if enough people believe in it and as a store of wealth or anything like that, and that it has value on the other side, that's probably all that matters, and maybe it's just that simple. Alongside, I get some of the democratization things that could be helpful, particularly in places where they can't trust their financial systems. Like I get both of those parts to it. But one thing's for sure, like if I ever think about the very small holding I have in crypto, it tends to be with a nervousness around those codes, and how fickle they are in my hands. That's not true for everyone. And thinking about that, so the idea that you can hold these in an asset which is sort of someone's looking after a lot of that safekeeping for you is quite nice. But I guess that comes with fees. Have you got any ideas of the fees? I have heard there's been some fee competition about. Have you been following that at all?
Yeah, I mean, there's so in the 11 ETFs that have launched, we're already seeing there's obviously, I mean, it's quite interesting that they all sort of went to the SEC at different times, but because they were held up with then suddenly the SEC decided that they were going to go for it, and to be fair, at that point had to kind of just let it all out at once. So it's kind of a big wave on the market. So now we're seeing sort of how they compete with each other and how they go for fees. So a number of, if you are interested in investing, do look carefully at what the fees are, because there are a number of different arrangements. Some of them are lower fees, some of them are slightly higher fees, but have fee holidays for the first sort of year, or I think the BlackRock fund that's in there has a fee holiday for either a couple of years or up to sort of $4 or $5 billion size. So when they hit that size, then the fees may change. So if you're very fee conscious, do look at what those things are. But you are paying, as you say, for the service of not having to worry about 12-word phrases, codes, and keys. And that has been one of the huge sort of issues for mass adoption, if that's a good thing, of crypto assets, has been just the difficulty, because these are things, products, ideas which are designed by tech people, basically. So the overlay of user experience on that has been, a work in progress. I mean, there's no coincidence that, New Zealand has a company called Easy Crypto, which is about sort of, let's try and make the experience more palatable for people who are not crypto native, dyed-in-the-wool tech heads.
Another thing we hear a lot through Sharesies, and is talked about, or a lot in the things that I read anyway, is the environmental impact, particularly with regards to the mining, the amount of energy used in mining a Bitcoin. So maybe we might want to start by talking about what mining a Bitcoin means, but just interested in the launch of ETFs, and if there's any view on how that impacts that or changes the outlook with regards to the environmental impact of Bitcoin.
That is a really interesting topic, and one that's really important. So Bitcoin, as you say, let's talk about mining for a moment, just so people understand. The way Bitcoin works is that it's a decentralized ledger, which just means that there is embedded in code somewhere a list of who owns which Bitcoin, or what fraction of a Bitcoin is maintained within the code. In fact, within a series of blocks on a chain, hence blockchain. And the real question is, without having an intermediary like a bank or a government to say what goes on the chain, what information is recorded, you need to have what's called a consensus mechanism as to how you add information to the blockchain. And Bitcoin does that by a process called mining, which both adds information as to transactions. So I give you, Leighton, 1 Bitcoin, that'd be nice. The transfer of ownership in that would have to be recorded on the blockchain, and that would then show that you now own that Bitcoin. For that information to be added to the block, there basically runs a process whereby people compete around the world by running software on their computers, mining software, to solve complex algorithmical problems which are generated by the code. And whoever actually sort of solves that problem by running their computer gets to add the information to the blockchain and is rewarded by the issue of some new Bitcoin, which is actually also how new Bitcoin enters the market. So that's kind of the monetary policy of it as well. Why does it do this? And why does it do it by asking people to run software on their computers? Because that costs money. And what that does is it puts a cost on people from playing that game, rather than just doing something which is costless, because that's therefore to stop people just piling in and fraudulently sort of trying to control the system. So you have to have a cost to run that mechanism. Now, with Bitcoin, as it has got so successful, lots of people are running computers 24/7 around the world, and it is using a lot of electricity. So that is an issue. There's a lot of debate over how much of an issue it is, or whether there are solutions. For example, solutions which are being worked on is ensuring that some of the Bitcoin mining is done in areas using renewable electricity. And in fact, because it's 24/7 and it can pull electricity from grids at different times from people in cities and things, it can actually help the efficiency of some of those markets as well. Again, I'm not the expert who can tell you whether overall it's a good or a bad thing. The other things that are happening is that people are using sort of systems that sit outside the blockchain and the mining process so that they don't use as much electricity. And then also remember that, leaving Bitcoin to one side for a moment, crypto and other crypto assets are all doing different things as well. So the second most valuable crypto asset, Ethereum, actually moved from using the system that Bitcoin used, which was highly energy sort of intensive, to moving a different system which uses 0.001% of the energy to run the same sort of consensus. So there is an evolution in these things. But yes, if you are concerned about the environmental impact of Bitcoin, that's an appropriate mechanism or framework or lens to think about these things, do some research, decide whether you think it's an issue. I don't know really whether the holding via the ETFs is going to really change that, because actually the entry of new information onto the ledger is going on regardless of how the actual Bitcoin are held.
You also just touched on Ethereum there, so the second largest crypto, certainly the second most known as well, I think, often goes by the nickname ETH. And where's that with regards to ETFs and things? Is there thinking of their applications? Anything you know about that?
Yeah, there are certainly works in progress. There are funds that invest in ETH, but they're not listed funds or certainly not ETFs that you can trade through someone like Sharesies at the moment. It's a work in progress. I believe there are some things under consideration with the SEC, but I don't know exactly what the status of them is.
Do you have any view on the tax differences? So we've got tax on the sale of direct crypto holdings. There's the fifth rules, which is for international holdings. Anything you can share about that for New Zealand investors?
Yeah, absolutely. And I'm going to talk carefully because I'm not a tax lawyer, but I sit close to some tax lawyers and we spend a lot of time talking about this. Our tax team has worked quite closely with IRD in developing some of their policy around crypto. And obviously we work with a lot of clients in this space to try and sort of solve problems. So the thing with Bitcoin, if you're just buying it yourself and holding it and selling it, is that IRD takes the view that because you can't really, holding Bitcoin doesn't give you a rights to a dividend or something, doesn't give you a right to a rental stream, like if you own a property, then it's an asset that if you're buying it, you must be buying it with the idea of reselling it, either as an investment or even if actually you pay for something with it. Because it's not money, when you pay for something with it, you're effectively selling it. So that's why IRD takes this view that, like gold, which is treated in much the same way, that if you buy Bitcoin at $100, great bargain, and you sold it then at $150, then that $50 gain that you make is effectively gain that you made from an asset that you bought with the intention of selling. So therefore you pay full income tax on that asset. Now, that's obviously different from just buying shares where you're buying them for a long-term investment with the expectation perhaps of dividends. So without having a capital gains tax in New Zealand, if you then sell them, then the gain that you make on the sale of those shares would generally be tax-free unless you were in the business of buying and selling shares, or specifically you had bought them with the intention of reselling them. Now, this is for New Zealand shares. We'll get into sort of foreign shares and the fifth regime in a sec. So if you had a fund that you invested in and then you sold your interest in the fund and made a profit, you would normally think that that would be treated in the same way as shares, so it would be effectively tax-free so long as you weren't trading or bought with the intention of resale. The issue with these ETFs, I think that people need to think about carefully, and we don't really know all of the answers yet, and you probably should take tax advice if you have an issue. Because for a start, they are US funds. So if you're a tax resident in New Zealand and you buy them, then you need to think about the fifth rules, which are the fifth FIF Foreign Investment Fund rules. And they say that if you hold interests in shares that are overseas based of more than a threshold, de minimis threshold of $50,000, then you need to actually pay tax on them, generally applying for an individual investor something called the fair dividend rate, where you assess sort of 5% of the value by cost of what you've bought once a year with adjustments for quick sales and things like that. It all gets very complicated. And then you pay income tax at your marginal tax rate on that 5% value. What it means in effect is that if you own foreign shares, that you have to make a small tax payment each year, even if you haven't sold them and even if you haven't been paid dividends. On the other hand, by making that payment, if they do pay you dividends, then you don't pay any extra tax on those. It's my understanding. I'm not a tax lawyer. Get some advice. What that means is for these ETFs is, because they are foreign funds, if you are above that threshold, you may need to pay tax using that sort of small calculation, even if you don't sell them. So in some respects, that might be worse than holding but not selling Bitcoin directly. On the other hand, if you want to sell your Bitcoin and you make a big profit, then you pay tax on the whole profit. If you want to sell your interest in the ETF, then you come to the analysis of, well, why did you buy them? Were you trading or were you buying with the intention of resale? And probably the one thing we haven't quite figured out yet, or that people need to think about, is can you buy shares in a US ETF which is never going to pay you a dividend because it holds Bitcoin? It's not a company, it's not investing in companies that aren't going to pay you a dividend, for something other than the intention of resale. So I'm just going to plant that seed because it's for tax people to figure out, but don't necessarily believe everything you read on Reddit. A couple of our tax partners have been reading some of the comments and going, yeah, that's not quite right. So just be aware that the tax always is going to be complicated when it's Bitcoin.
We've touched on a few of the pros, I think, of holding Bitcoin and ETF. Clearly, it is held by a regulated entity. It has supervision, custody, and things around it. Much easier. The platforms you can access it from, potentially quite cheap as well, I think, using more modern platforms. We've spoken about some of the limitations, mostly around the fact, I suppose, that you can't actually use it for a payment, which was the initial use case for it. And of course, there are some custody fees or some fees for holding that. But are there any other limitations that you think would be good for people listening to be aware of?
Sure. I mean, there's always risk. And I think even though the point I was making before is that even though the fund itself is regulated, the underlying asset is still Bitcoin, and Bitcoin is still capable of being traded in unregulated markets. What happens in those unregulated markets, particularly for the short term, maybe it'll change as more markets get regulated, and certainly the SEC, Securities and Exchange Commission in the US, is bringing action against exchanges and things, saying you need to be more licensed and more regulated. Countries like Australia are bringing in licensing regimes for exchanges. I've been one of a couple of advisors who've written a report for the government about things that we could do to regulate these assets in New Zealand. But at the moment, those assets can still trade by people who aren't subject to the same rules, and that could have effect on the volatility of the prices. So don't go into these things thinking that it's a one-way ship. You can look historically and see that it's performed very well in most years in the last sort of 10 years. On the other hand, in sort of 2 or 3 of those years, it's gone down really badly. And that absolutely could happen again. No guarantee of past performance, no guarantee of future returns, all that good stuff. And I guess just also understanding that some of the risks around the asset are different from risks that a company has. So it's not about how it performs in its market, what's the product it makes or otherwise. There could be technical risk around the code. Someone could find a way of deconstructing it or hacking it into it. Actually, Bitcoin itself, because it's quite simple and it doesn't really have people to hack or a single set of computers in its core, is quite resistant to those things. But once you start then dealing with exchanges and third parties, that becomes more subject to these sort of things. Plus, regulators could decide that they just really don't like the idea of these sort of unregulated currencies. Or they could be competed out of existence by governments sort of developing their own digital currencies, which is a thing which is happening, including in New Zealand. So there's a lot of things to think about as to whether it's something that you want to invest in. And you obviously need to understand it, and does it fit within your personal universe of what you want to do?
Yeah, I think that understanding level of exposure should be pretty highly correlated to level of understanding, I think, which is always a good way. And that's not to say, I think that gives a lot of flexibility. Actually, it means if you feel like a small hedge in something, which I think a lot of people are doing, which is, hey, well, just in case I've got this bit, you can do that. But before you go 100%, you really want to understand what those risks are, and there are lots. But on the other side of that, it's been around for a long time already, and despite being very volatile, if you straight line it, it's actually provided a quite consistent return for people as well. So heaps to think about on that. A huge amount of this conversation is around both the future of people's thoughts on digital money and how that will go. Like you say, will regulators even let it happen? We're how many years into it now? 15 years-ish. And then, of course, the ethics around it, the other types of things that it's used for, the impact on the environment, all those things are great things to consider against your own investment strategy before you have a look at it, but always worth doing the research. So I think we've covered heaps there, and might just call it there. But just to recap, what would you say is the one key takeaway from what we've spoken about today that investors need to know?
Yeah, I would say that if you're sort of Bitcoin curious or crypto curious, this is a much simpler way of getting exposure, because you are investing in something which is more readily understood, and you're also handing over the responsibility for custody and care to regulated bodies. So it's a relatively straightforward way of getting that exposure. But you still have to want to do it, and you should still understand what you're actually getting into. And certainly you can't assume that values will go up. They will go up and down, and it's historically proven to be one of the more volatile asset classes for investment. So by all means, approach it with that lens and get advice if you need it.
Absolutely. Hey, thanks so much, Jeremy, for spending your precious time with us today. It's been super informative, and thanks also to everyone for tuning in and listening. You can listen to Shared Lunch wherever you get your podcasts. Leave us a 5-star rating and a comment with who and what you'd like to hear about next. Enjoy the rest of your week.